Hey everyone, here's another great question for CIMA F3 Financial Strategy. We're dealing here with a purchase of a machine and it incurs a certain amount of interest to pay off the machine, which is quoted pre-tax. The tax amount or percentage is actually given in the question. And then what you are asked to do is to calculate the present value of the lease payments. The present value of the lease payments. So how you go about doing this is you obviously read through the question briefly, and what's very important to understand as well is that you need to understand what the terms of the contract are. So let's quickly go through it. Sansa Co. is looking to acquire a new piece of machinery. If buying, the machine will cost $1 million and will attract capital allowances on a reducing balance basis at 25% per annum. The life of the machine is expected to be 4 years with no residual value. If it is leased, the lease payments will be $275 per year in advance. In advance, that's very important. In advance. Sansa Co. can borrow from its bank at 8.57% per annum and pays tax at 30%. So the first thing that we need to do is we know, okay, 8.5%, when you're working with leases, we must work out the post-tax value of the interest that's over there. So the post-tax value of that interest amount will be 70 divided by 100, which is obviously you're trying to work out as if you had multiplied this by 30% and then seen what the net value would be if you had deducted tax from this. And that then equals approximately 6%. Right, so now we know what our interest rate is. We know that it's 6%. And we know that our interest rate is 6%. So we can go ahead and use that value to calculate what the PV values of the lease payments are. But what you need to keep in mind is there are capital allowances which also need to be present valued. They're the capital allowances, and they are calculated by multiplying the tax rate by the lease payment amount. All right? Okay, so the calculation is going to look like this. You've got 275k that you pay now. That's a negative. Plus 275k that you'll be paying, let's say, for example, on the 1st of January next year, assuming it's 12 months from now. And then again, a year after that, and again a year after that. So you'll have to multiply that by a certain factor. That then comes to 1010078. What you then need to realize is that you have to subtract capital allowances from this amount of a year. Now, how capital allowances work is tax deductions always happen they have an effect of the following year. So for example, if you paid $275 at the beginning of this year, then you would receive a tax allowance only at the end of this year. So that would have to be discounted by 1 year. Likewise, what's important to also understand is that you would then be discounting the tax allowances back to a certain period, which for argument's sake would be the 1st of January. 1st of January 20x1, which is 1 year after our original contract was entered into, which is the 1st of January 20x0. So all your capital allowances will be discounted using that 6% amount of interest value factor will be discounted to this period here, and once you've got that, that total amount of capital allowances then must be discounted again one period back. Why? Because this value, which is your total lease payments, are equivalent to, that is dated on the 1st of January 20x0. Alright, so we understand you need to work out the value of your capital allowances up till 20x1 and then discount the full amount back one more year. So how you do that is you take your lease payment of 275, so it's 275, and this lease payment obviously gets a tax rebate of 30%, which equals $82,500. So you got your $82,500, and this rebate, this tax rebate or tax allowance, occurs for 4 consecutive. So this occurs for it occurs for 5 consecutive periods. So in the future, the present value factor of that amount is 4,212, and that will take you up till 20x1, that discount factor. So you multiply 82,500 by 4,212, and you end up with a net value of 347,490. Remember I said earlier that's now got to get discounted by 1 year. That discounted by 1 year at 6% equals 327,820. Now that amount must be subtracted from that amount, and your net value works out to be 740K. Therefore, option B is correct.